talk about the stock market now and bond market with Joe Amato, President and Chief Investment Officer at Neuberger Berman. Has $508 billion of it, who's counting, in assets under management. After yesterday, it might be 509. It might be 509 billion. Yeah. Thanks for joining us.
Thanks.
Do you think a real bottom was made, or was it just a tradable bottom? What was it? Did you say it was my anniversary, March 13th? Was that? I think that was the bottom.
I think you said that.
Yeah, it was March 13th.
I think you've probably seen peak uncertainty on a range of policy outcomes, but I think there's still uncertainty, right? So market clearly has gotten more comfortable with the narrowness of the tariffs. However, next week we're going to have an announcement, and I think there is probably some headline risk that in a negotiating approach, the administration may put a very big number out there to then work its way back as it's done in the past. I mean, our base case is still that it's going to be relatively narrow, although tariff rates overall will move up.
When Becky was reading about Raphael Bostic, what occurred to me was he's totally basing it on inflation expectations, that we only get one cut because inflation stays sticky. But that would seem to imply to me that he doesn't think there's a serious growth slowdown coming in the economy that would cause, the Fed to have more than one cut. Do you think that all this, what we've heard about tariffs and Doge and...
I think uncertainty leads companies to delay decisions. So if you think about capital allocation decisions, whether it's capital expenditures or M&A, I think clearly they've pulled back. Now, how does that ripple through the economy, depending on how long this lasts? We think there's still going to be two cuts this year. We think there's certainly a bit of a growth scare / slowdown. Our recession odds have really not moved up that meaningfully. And the Fed is there, right? Because if you do see that growth slowdown, I think they could move aggressively.
Some people are at, what did you say, 43%?
Yeah.
And I think, you sure it's not 42%? I mean, it's ridiculous that like you have any idea.
All sense of precision.
Yeah, exactly. Yeah. But do you think it's as high as, that's almost 50%?
That feels higher. I mean, there's a...
What do they see?
Percentage of recession risk in every year, right?
Right, yeah, what is it? 20% every year.
But if you see a spiraling and a retaliation that then puts real pressure on growth, right? If these tariffs that were announced a bit ago are in place for a full year, you're going to see, at least in our view, a half a point less of economic growth. Now, that doesn't mean recession, but that means lower growth. And you'll see a bit more inflation. So it actually puts the Fed in a tough spot, but I think the Fed's going to be more focused on growth. In terms of...
More focused on growth than inflation?
More worry about growth, absolutely.
And more likely
tariffs increase inflation.
Even if inflation
it's essentially a one-year price adjustment, right? Growth can sustain itself over a period of time.
More concerned about inflation.
Well, I think they're very focused on the labor market. If you see cracks in the labor market, which is really tied more toward economic growth, I think the Fed gets more aggressive here.
When we entered the year, let's say we didn't have any of the tariffs or Doge, we were still back-to-back 20% years. We're still at 22 times earnings. So even in the best of scenarios, the market was richly valued and maybe not expected to do 20% again, unless, I guess, the regulatory environment is a real tailwind, which some people thought for animal spirits. And, taxes for corporations are going to stay at 21. They're not going back to 25 or above that. And other taxes might come down. Do you think we could have had another great year if there wasn't this uncertainty? Or were we doomed to a consolidation?
For 25, in our view, was going to be a broadening out of the market. So the stocks that have gotten pounded the most are the ones that have done the best over the last 2 years, particularly some of the mega cap technology stocks, right? So they're down, in most cases, double digits or more for this year. But if you actually look at value's up for the year. Value's up 2.5%. The S&P overall is down a couple percent, driven by those mega cap stocks being down. So that broadening out theme is an important element of that push toward deregulation, improved permitting, stimulating the domestic economy. I think will lead, again, to that broadening out. When
would you get bullish on domestic companies in manufacturing based on what wouldn't it be years before you see the fruits of
Yeah, it certainly takes time to put capacity in place, but I think markets always discount that ahead of time. So I think, again, that rotation into value in some of those sectors that have actually struggled the last couple of years. Right, because it's been a quasi-recessionary environment for, let's say, the manufacturing sector. Now, the U.S. economy is still services-driven, Right, and yesterday you saw a very strong PMI services number, so I think that shows you the U.S. economy is still going to be resilient here.
I mean, is Neuberger, Berman bullish on these economic initiatives, that even Doge?
Yeah, I think there's a series of very pro-growth business initiatives that in many respects are long overdue.
Does a combination of pro-growth business and maybe shrinking the size of government, does that make you think interest rates don't have to go up, even if the economy is strong? Could rates come down based on that?
I think enhancing productivity is going to be an important issue, right? If you enhance productivity, I think that's going to lead to more sustainable, longer-term economic growth. And we've seen over the history, if you go back 75 years, right, you've seen these waves of productivity improvement when the public sector is receding. Yeah. And then when the public sector invests significantly, you see productivity declining, right? Whether it's World War II to Vietnam, Vietnam to Reagan, Reagan to the war on terror. During periods of much more aggressive government spending, productivity tends to recede. So I think we're at the stage of an improving environment for the private sector.